Hi everyone, and welcome to our next video in our Forex training course. Today's video is about how to read a Forex quote. In the Forex market, you are basically buying currencies, and the object of trading Forex is to exchange one currency for another with the expectation that the price will change and you will make money from this change. Because currencies are always traded in pairs, you are always simultaneously buying one currency and selling another. The currency you buy needs to increase in value compared to the currency you sold. Now let's learn how to read a Forex quote. The first listed currency is called the base currency, and the second listed currency is known as the quote or counter currency. So in this example, US dollar is the base currency and South African rand is the quote currency. So according to this quote, in order to buy one US dollar, you would need 14 rand 44. And if you sold one US dollar, you'd receive 14 rand 44. Now you will buy this pair if you believe the base currency will gain value relative to the quote currency, and you would sell this pair if you think the base currency will lose value relative to the quote currency. Now you're probably wondering, how do you sell something that you don't own? Well, now is the perfect opportunity to talk to you about short and long positions. Before entering a trade on the Forex market, you need to decide whether you want to buy the base currency or whether you want to sell the base currency. If you believe that the US dollar is going to strengthen, you would buy the pair. This is called a long position. It has nothing to do with the length of time. It is just the term used if you enter a trade by buying. Because Forex is a two-sided transaction, you are buying the base currency and simultaneously selling the quote currency. You want the base currency to rise in value, in this case the US dollar, so that you can sell it later at a higher price and make some profit. If you do this, you are going long or taking a long position. Remember, long equals buy. Now the inverse applies if you believe that the US dollar is going to weaken. You would sell the pair. This is called a short position, and like a long position, also has nothing to do with the length of time. Instead of buying the base currency, you are buying the quote currency in this case, which means you will be selling the base currency because of the double-sided transaction. You want the base currency to decrease in value, in this case the US dollar, so that you can buy it later at a lower price and make some profit. If you do this, you're going short or taking a short position. Remember, short equals sell. It is very important that the buy or sell action that you perform has to do with the base currency. So to summarize, a long position is a trade that you enter by buying. So you buy the base currency and sell the quote currency at the same time. You want the base currency to rise in value and you sell it at a higher price to make a profit. A short position is a trade that you enter by selling. So you are selling the base currency and effectively buying the quote currency. You want the base currency to fall in value so that you can buy it at a lower price to make some profit. You should also take note that there is a difference in the price at which you can buy and at which you can sell at any given time. These two prices are known as the bid and the ask price. Now this is a screenshot from our trading platform. As you can see, there are two different prices listed. If you buy or sell, you'll be doing so at different prices. These are known as the bid and ask prices. The ask price is the best possible price you can buy the pair from the market. The bid price is the best possible price at which you can sell the pair to the market. In this example, for a long position, you would buy at the ask price of 14.30767 and you would sell at the bid price of 14.29890 for a short position. Now, as stated earlier, there's a slight difference between these two prices, and this difference is known as the spread. The difference between the bid and ask price is known as the spread. The spread will always be there, but the size of it will fluctuate slightly. This little difference in price is how the broker makes their money on Forex transactions. So now that you understand how the prices work in Forex, let's move on to how the actual trading works. To understand this, you'll need to understand two very important things: leverage and margin. Leverage and margin are two terms that you often hear in Forex trading. Let's start with leverage. Forex is a leveraged product. So therefore, this is the only way that you can trade Forex. Now, the textbook definition of leverage when it comes to Forex is having the ability to control a large amount of money using none or very little of your own money and borrowing the rest. For example, to control 100,000 Rand, your broker will set aside or reserve 1,000 Rand from your account. In this case, your leverage would be 1% or 100 to 1. To understand leverage completely, you'll also need to understand the term margin. Margin is basically the deposit that you need to put down in order to open a position with a broker. As mentioned earlier, it's normally expressed as a percentage or a ratio. Different brokers offer different leverage. ProTrader, which is the platform that we use through Velocity Trade, requires 1% or 2% margin depending on what size position you take. Trading on margin means that you are placing a deposit down with the purpose of borrowing money from the broker to purchase currency. Margin or leveraging offers you the opportunity to trade way more currency than you would normally be able to. Although this offers you the opportunity to amplify your returns, it also significantly increases your risk. Leverage is a double-edged sword, so one needs to exercise very strict money management to lower your risk of wiping out your account. Money management will be covered in one of our later lessons. Well, there you have it. We've reached the end of our video on how to read a Forex quote. We hope to see you at our next video.